me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks rising after the Fed's preferred inflation gauge came in below expectations. The MSCI Asia-Pac Index snapping a 6-day decline while the dollar steadies. Panama rejects Donald Trump's threat to reimpose U.S. control of the Panama Canal after Trump complained American vessels are charged high fees. Silverdale bond funds will be with us to give their take on how Trump could impact markets. Also ahead, Japanese media say Honda and Nissan are looking to finalize a merger agreement as soon as June. NHK says Honda will pick the president of the holding company with Nissan. Plus, M&G Investments gives us their outlook for India next year and the challenges they see for markets. Well, looking at markets, we have the MSCI Asia-Pac Index trading at session highs, driven pretty much by Taiwan. That's on the back of news that perhaps NVIDIA could be planning a headquarters in Taipei. Well, we're also tracking gains in the markets on the back of the PCE report out of the U.S. coming in lower than anticipated. Perhaps it could prompt the Fed to continue its easing cycle. The MSCI Asia-Pac Index up about 1% right now. The CSI 300 Index also in positive territory, up 0.8%. The yuan is the currency in focus. The yuan fix today 1,000 pips below expectations. Now, our top story, Donald Trump is a month from taking office, but already he's sending shockwaves around the world. His latest target is Panama, as he threatens to reimpose U.S. control over the Panama Canal, claiming American vessels are being charged exorbitant fees.
The fees being charged by Panama are ridiculous, highly unfair, especially knowing the extraordinary generosity that has been bestowed to Panama, I say very foolishly, by the United States. This complete ripoff of our country will immediately stop. It's going to stop.
Meanwhile, Panamanian President Raul Mulino fired back at Trump's attack, asserting that rules regarding the canal are non-negotiable.
Every square meter of the Panama Canal and its surroundings belongs to Panama and will continue to be. The sovereignty and the independence of our country are non-negotiable.
Well, for more, let's bring in Bloomberg Asia senior editor Bill Ferris and Sanjay Guglani, who manages more than $1 billion as founder and CIO of Silverdale Bond Funds. Bill, let's start with you. Looks like, it's chaos all over again. Trump says he wants to take back Panama Canal.
Yeah, he's trying to now talk about a treaty, a deal that was made back in the 1970s. I think it shows us the kind of unpredictable world we're heading into once Donald Trump takes office on January 20th. Countries that were not on your radar, agreements that were not on your radar, are going to come up for Trump's ire if he thinks it's a bad deal. Whether it has any concrete or substantive impact on the real world, that remains to be seen. But he's certainly taking a look at these things. It makes you wonder who was talking to him about Panama and the canal over the weekend. But it's, again, the kind of thing I think we'll be seeing a lot of over the next 4 years.
Sanjay, welcome to Trump 2.0.
Pleasure.
It's going to be more of the same of what we saw in the 4 years of Trump before.
Yeah, so the key point to make a distinction is in terms of what he says and what he does. Trump is a great negotiator, so it's typical of his style to put gun on the table and negotiate. So while there will be volatility in the market, but for long-term investors, it's good news because the walls give opportunities to invest.
But the thing is, markets are driven pretty much by headlines, and Trump makes headlines on a daily basis, in fact, several times a day.
That's only good, because if you know the value, you know when to catch it.
And Bill, when it comes to Panama, I just want to put it out there. It is a strong U.S. ally. If a strong U.S. ally can go through such a process under Trump, I mean, you can expect, the rest of the world can expect, even the unexpected
Absolutely. And of course, the U.S. ships are paying the same rates as other ships passing through the canal. There is this historic relationship between the U.S. and Panama. But we just saw, a week or two before this latest episode, you had Trump going after announcing potential 25% tariffs on Canada and Mexico over the border. That prompted Justin Trudeau to fly down to Mar-a-Lago. It's prompted a shakeup in the Canadian government. I don't think whether you're a friend or a foe or a rival or somewhere in between that you're going to be safe from Trump's ire over the next period, the next 4 years.
It goes back to what Trump has been saying. It is an America First policy. If it's not in America's interest, then you're going to pay the price.
Absolutely. I mean, he has said he thinks some of America's allies have given the U.S. the roughest deals. At the same time, he's offered praise for people like Vladimir Putin and Kim Jong-un. So I think it's just going to be a really tumultuous 4 years, not just for the markets, but for global geopolitics as well.
So it's brace for the markets. I mean, how do you play this market? And we've been talking about the Trump trade. Is it just the beginning? Is it close to the end? People have factored in a lot of the Trump trade already.
The key thing to keep in mind is to look at the big picture. It's very easy to get swayed by one tweet here, one tweet there. And from the medium-term point of view, yes, what he's talking about definitely helps US. Let's not deny that basic fact of it. So the key point is that as investors, what should be doing it? That's the most important thing, rather than carrying away by the news. And in that regard, I think, especially in the fixed income world, there's still a lot of juice there. A lot of yields are still, all-in yields are still high enough for you to focus upon it, especially in the short end between 2 to 4 years.
So the theme of U.S. exceptionalism will continue in 2025, but for how long?
The key point is that when you talk exceptionalism, which portion of the market you're talking about? If you're talking about equity market, to a large extent, yes. Also because of the fact that we are seeing a total productivity factor in U.S. to be much higher, and which could take a quantum jump with AI, and U.S. is indeed a leader in the AI. So we understand what's happening in that portion of the market. But in the rest of the market, if you look in terms of fixed income sector there, there's a lot of other opportunities available.
And Bill, we talk about the Panama Canal. It actually is linked to China. I mean, he took issue with the fact that, China possibly controls the canal simply because it is the second largest customer.
Yeah, it's the second largest customer, although basically 70% of that trade going through the canal is linked to the U.S. And U.S. exports to Asia, including Japan, including to China, those go through, including LNG shipments, and that goes through the canal as well. So I think he's a little bit concerned, I think, about Chinese control of a couple of the ports there. Ultimately, the U.S. has a role in providing military support if there was any effort to prevent countries from being able to access it. But the reality is all the world's trade has benefited from having the canal. Panama has had to increase rates because of water shortages that's made it harder to operate. But it's certainly something the U.S. continues to have full access to, along with other countries.
And given, how Trump is looking at it, I mean, these America First policies, global leaders are already playing into that game, right? A lot of global leaders are already trying to negotiate and be on the good side of Trump. Give us some examples of, what's been key, what's been a standout. We talked about Trudeau earlier on. It's also the leaders in Israel, for instance. Netanyahu has been, having talks with Trump.
Absolutely. I mean, I think every country, no matter what you think your relationship is with the U.S., heading into the next 4 years, you want to have plan Bs and plan Cs to negotiate. So even though you think you have a good trade deal or a good relationship, be ready to negotiate and bargain again on things. So we're also seeing this, you mentioned Netanyahu with the war in Gaza. I think we've seen both sides in the Ukraine-Russia conflict rushing to try to secure territory, stake their claims to different parts of the country because they know they may be under extreme pressure to reach a deal regardless of where they are at after he takes office on January 20th. But, we saw with Trudeau, he flew down to Mar-a-Lago right away, he made some announcements about increasing border security, even though the Canadian-U.S. border is not really the problem that Donald Trump has publicly made it out to be. So have a plan.
Have a plan, and that plan should include, how you counter risks and uncertainties in 2025. How do you do that, Sanjay?
The key thing is to keep into account the fundamentals, right? So if you look in purely fundamental point of view, being in a fixed income world, are the all-in yields attractive? Absolutely yes. We are still in the close to top quartile in terms of all-in yields. Would it impact in terms of short-term? The answer is no, because short-term interest rates are more determined by the monetary policy, and long-term interest rates are more determined by the fiscal policy. Fiscal policy point of view, yes, there is a danger. We are already seeing the long-term neutral interest rate to be increased from 2.9% to 3% by the Fed in the last report, and it's expected to still go up. Right? And if the Fed doesn't contain the deficit, and with Trump we can expect little more than what it was earlier, then long-term interest rate will still be climbing higher. So from the strategy point of view, it makes sense to focus on the short term. And now comes the fun portion of it. With the presidential tweets, you could get a lot of opportunities, even the short end, to make a lot of monies.
So where do you think the most money can be made if you take a look at the Asian market?
So Asia is uniquely a position because unlike US, which went bonkers in terms of COVID times and rollouts, Asian economies were very sanguine. So they didn't actually go for the sort of monetary easing which the American did. So the Asian economies in a big picture point of view are fundamentally much stronger. So they can take the time in terms of responding in terms of the US Fed sector out there. So unlike previous times, we haven't seen the Asian central banks reacting immediately to the Fed movements. So that makes a lot of sense to look from that point of view. Now from the Asian corporate point of view, it's brilliant because many of these Asian corporates are able to refinance US debt into local currencies. We saw the Chinese, we saw the Indonesian, we saw the Indians, huge amount of refinancing happening in local currencies. So for global investors, brilliant, because there's one more avenue where the companies can get refinanced, so it's good for the bond investors.
All right, Sanjay, hang tight. Sanjay Guglani of Silverdale Bond Funds is sticking around. Bloomberg Senior Editor Bill Ferris, thank you so much for your insights. Now, still ahead this hour, well, Indian stocks are closing out the year on a weaker note. It's still been a stellar decade run with the benchmark Nifty on track for a 9th straight yearly gain. We'll take a closer look with M&G Investments. Keep it here with us. This is Bloomberg.
They have cash problem, they have investment problems, they're being really hammered in the United States, they got practically out of Europe, they're being challenged in China, and there is no plan in front of it. So I can tell you that there is panic mode inside Nissan.
And that was Carlos Ghosn, former chairman and CEO of the Renault-Nissan-Mitsubishi Alliance, on a potential merger between Nissan and Honda. And NHK is reporting Honda and Nissan are aiming to reach a final agreement on their planned merger in June. Our transport reporter, Nicholas Takahashi, joins now from Tokyo with the latest. Nicholas, take us through what you're hearing right now.
So we're starting to see this long-awaited alliance between Honda and Nissan take shape. This is a partnership that's been in the making for years now, just sort of beginning to escalate in the last couple of weeks. But the government's been pushing for this partnership for a while now, and what we're seeing from local reports, starting to spill out over the weekend and this morning, is that Honda and Nissan are weighing the formation of a holding company helmed by a president hand-selected by Honda, according to NHK reports. So this is in line with a lot of the speculation we've been following for a couple weeks now. But as these details are hashed out over the next couple months, leading up to June, according to NHK again, we're going to start to see this partnership form and what kind of balance it takes when it comes to decision-making and resource sharing and cost-cutting efforts.
And we're also hearing, Nicholas, that it has a lot to do with China. I mean, how Japanese automakers are losing market share in China. And, it's a very competitive market, given BYD, for instance.
Definitely. I think in the background, China is the biggest element. China, with EVs exploding, brands like BYD rolling out wave after wave of EVs, and then in the in the U.S. market as well, with hybrid selling so well. So poor sales in the US and China are what forced Nissan to cut jobs, slash production capacity, and lower its annual profit outlook. And in that weakness came talks of a merger with Honda. I mean, the presence of Honhai, the iPhone maker known as Foxconn, definitely put pressure on those talks, and moving forward, Honhai has said it'll sort of back away as the merger talks continue. But the presence of Honhai, challenges in China on EVs and hybrids in North America are sort of the churning background sort of dynamics of this entire conversation.
Nicholas, thank you so much for that. Our transport reporter, Nicholas Takahashi. Now, with us still, Sanjay Guglani, founder and CIO of Silverdale Bond Funds. He's still with us. He cites Japan as one of the markets for fixed income market opportunities. How so? Why?
Japanese economy is going through a transition, as we all know. So it's slowly merging out of it. Next year, we expect it to grow by almost 1%. So in that particular background, we are seeing a lot of opportunities, specifically in terms of high-yield space in Japan. And that gives good value. They're giving a fantastic spread, even if you were to swap back into US dollar. So there's a lot of opportunities there.
How about the yen? How are you assessing yen weakness right now? I mean, some say that if we get close to 160, we'll see further verbal intervention. I mean, we've had verbal intervention going on for all of this year already.
So there are two very interesting aspects of it. One is that in terms of verbal intervention versus actual intervention. So from the Japanese point of view, they would not be any time eager in terms of stopping the depreciation of yen, caveat Mr. Trump. So, you can expect certain tweets and certain action by the president pushing Japan to take action, which we saw earlier also in his Trump 1.0, where he talked about in terms of being currency manipulator. So there's a very thin line to tread, but yeah, that's what it is.
So where do you see the yen trading in 2025?
It should be around that, around 155, 160, depending how good the relationship between Japan and the US will be.
Speaking of Japan, some are talking about Japanification of China. I think you're among those looking at that as well. I mean, how do you play that?
So that's something to be absolutely careful about, because if you look in terms of yields, long end of Chinese yields are even today below Japanese yield, which was completely unthinkable even 2 years ago. We are seeing the same sort of age, the demographics playing out in China. The most important thing is that for almost 30 odd years, the Japanese central bank and the people didn't take concrete action. And unfortunately, what we are seeing in China is same, that we are not seeing concrete action. A lot of news, a lot of headline news stories, but very few follow-ups. And that's not a good sign. So
in the next 6 to 12 months, where do you see Chinese yields headed? We've seen how yields have been trending lower. In fact, one-year yield was at the lowest since 2022, 2023, thereabouts. I mean, are they going to be trending lower even more now?
See, unless until we see certain thing where the economy improves, specifically in terms of domestic demand, that is something which is severely lagging. In terms of consumer confidence, which is an all-time low. In terms of foreign investors' confidence in China, it's all-time low. Unless these things the sector improve, it's unfortunate slow glide down on the path.
The thing is, easing yields are a result of expectations that monetary easing is coming and more stimulus perhaps is also coming. Is it realistic to think that China will move?
There are two aspects of it. Yes, you're right, absolutely, in terms of the expectation. It's also in terms of alternate people have in terms of investments. Right? If the economy is not really doing very well as it should be from the historic perspective, then people are reluctant to invest. Right? I'm talking about hard investment, not only the stock market investment. And this also determines in terms of where the yields are going to be.
The other asset class that we're looking at is, of course, the Chinese yuan. We saw how the yuan fix today was more than 1,000 pips below expectations. It does seem like, the PBOC is unwilling to see, too much movement in the currency.
Yes, headline story, yes, they would not like to see a huge appreciation for that matter, very sharply. But it's in China's interest to keep the yuan, at a lower level. caveat again is that as long as they are not be classified as currency manipulator, they don't want to antagonize before things go in terms of negotiating table. Let's not forget Trump has called the Chinese premier on his inauguration, so we should see some interesting silent talks coming from there.
Where do you see the yuan headed in the next year?
It's a very much a pick of things, but on the whole, yes, we should expect another about 3 to 5% depreciation from here.
And what kind of stimulus do you see from China?
That's a billion-dollar question, a multi-billion-dollar question.
It's something we've been waiting. We've not seen just yet.
Absolutely. So the question is not in terms of what they announce. Question is what they do. They talked about increasing the fiscal deficit to almost 4%, which on the paper looks fabulous, but we shall see how we actually implement it. And the key problem is that it's a classic problem when they have flaunted so many times that even if they do, people will take a pinch of salt. So it will take time before it unfolds. And from the investor's point of view, it's brilliant because it means no need to rush into the place. But yes, if you actually see action happening, there's still time for you to react on it.
Whenever you look at the world today, you get a sense that uncertainty will persist in 2025. What are your conviction calls? Where are you looking at for the best returns for next year?
So we prefer the 2 to 4 year duration bonds. And as always, instead of going down the credit curve or taking a duration risk, we prefer to use leverage. The high yield market in particular is very, very interesting. For the first time ever, we have seen 56% of high yield market to be BB rated. Historically, around 40%. And more interestingly, 35% of high yield market is secured. I care for the company, but I care for my securities more, right? So we're getting secured bonds. There's a lot of value there. And that value translates across the board. We talked about Japanese. We see the same opportunities in Indian high yield space. Huge amount of value in a country which is growing at a clip of about 6-7%, a 4 trillion economy, which is still rated at BBB.
Aren't you concerned that this is an economy that's actually slowing down? I mean, GDP was way short of expectations.
Yeah, but that's part of the seasonal aspect of it. But look from the big picture point of view, a 4 trillion economy growing even at 6% is fabulous. For me, the way we are looking across is the fundamentally. About 30% of all Indian companies with US dollar bonds are due for credit upgrade. 30%. The majority of the capex in India, which instantly has picked up in the private sector, is being funded from the operating cash flow. For the first time in India, we have seen the lowest ever non-performing assets. We have seen continuously the leverage coming down, the revenue going up, profits going up. Default rates are one of the lowest. So if you have a fundamentally strong economy, companies which are strong, which are still giving you good yield because they're still BB, it makes sense for you to look into it from the investment point of view.
What other high-yield markets are looking attractive? Might Indonesia qualify?
Indonesia, we have some select names there, but I should caution that given the size of the market, there are only that much which can invest into Indonesia.
Okay, so not liking Indonesia too much. If there's another high-yield market that you might be interested in, apart from India?
Across the board. So I mentioned about even in terms of certain names in Australia, certain names in Europe for that matter. There are a lot of values across the board. Remember, the default rate in high yield today is one of the lowest we have seen.
Right.
From the risk-reward point of view, it makes tremendous sense. And also because of the fact that the quality of the high-yield universe has become better and shrunk. And it is shrunk because majority of that has gone out of the fixed income in a high-yield market, which is brilliant for investors those are still into high yield.
All right, Sanjay, thank you so much for your time today. Sanjay Guglani of Silverdale Bond Funds. Of course, we have the dollar pretty stable, giving some reprieve to Asian currencies. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Yen bulls are in retreat as hopes fade for a fast narrowing of the US-Japan rate gap. This follows central bank meetings last week, which featured a hawkish Fed and a dovish BOJ. Avril Hong has more. Avril. Yeah, Hans. I mean, despite that softer dollar after US data, despite Japanese finance minister delivering verbal intervention, the path to least resistance for dollar yen still seems to be of upward trajectory. You think about the dovish messaging from the BOJ governor last week, it's really not enough to beat back the yen bears, and they are out in full force. It looks like you look at the leveraged funds, they have turned the most bearish against the yen last week since July. And you think also about some of the swaps pricing, right? The January pricing is less than a 50% chance that markets see a BOJ hike. And if you go further out, in March, I think it dwindles even further. So clearly here, not enough for yen bulls to get excited. Think as well also about the messaging that's come from Ueda so far, right? He's signaling dovish, and the sense you get is that, does this come at the cost of his credibility? Because clearly the data in Japan backs the case for BOJ tightening. If they're tightening instead just to support the yen in times of weakness, then what does this mean about the BOJ's logic? Does this sort of punch holes in its policy? Flip the board, because we're back from the lunch break in Japan as well. So just raking through what we're seeing on stocks as we keep a close watch on that potential merger between Honda and Nissan. NHK now reporting that they're looking to finalize a deal by June. So at least we have a timeline of sorts. Nissan stock has mostly been rising on the back of the news of the potential merger, a bit of a pullback now. Honda is interesting because investors had been flashing a negative reaction, the concerns that there's a bailout element, that it's going to be bailing out this Nissan that is in much dire straits. That share reaction seems to have turned positive today. Potentially the idea of investors re-evaluating given the longer-term prospects for Honda. Flip the board again, take a look at how the broader benchmarks in Japan are faring, because they are in the green today as well, and this is tracking what we saw on Wall Street following the US data, but also the sense of how the Fed cuts are coming soon, and that seems to be spurring not just the auto stocks, I think, that are in positive territory. The tech sector is really what's leading the gains in the region and specifically in Japan today. That's right. That PCE report, which we got on Friday, less than anticipated, perhaps, could just prompt the Fed to cut even further. Avril Hong, thank you so much for that. Let's stay with Japan. SoftBank preparing to bet big on AI, and part of that has to do with the company investing $100 billion in the U.S. That's the focus of today's Big Take. Our technology editor, Mayumi Nagishi, joins us now. Mayumi, what is Masayoshi-san trying to do, and why?
Well, Masayoshi-son is certainly back and here to try to cement his legacy. He sees a huge opportunity in the world of AI hardware. Masa was an early investor in NVIDIA, but sold it in 2019, only to watch NVIDIA come out as this unrivaled leader in AI. And this is something that Masayoshi-son has been advocating for, championing for decades, decades. And he kind of sees an opportunity for him to fill via his 90% stake in ARM and its energy efficient chip architecture. So he wants to go into the AI accelerator space. Our reporting shows that they're ready to push out a prototype as early as this summer for shipments next year. The grand vision is to have AI chips everywhere in all kinds of electronics beyond data centers where NVIDIA rules. And this could mean deploying huge parts of SoftBank's group, which comprises ARM, of course, but also the telecom company in Japan and renewable energy companies in the U.S.
You got to wonder what the market thinks about this strategy. What's different this time if you compare it with the Vision Fund?
Well, I would say the big difference is that we're talking about a much humbled Masayoshi Son, a chastised Son who's been burned through some big flops at the Vision Fund. We're also talking about a Masayoshi Son who is now going into uncharted waters for him. He doesn't have much experience in the manufacturing side. He's a great operator, but he's never been tested in the manufacturing side of things, let alone in the world of semiconductors. So he's forced to engage in dialogue with his engineers. He's forced to listen to any of the technological hurdles that he might face that would slow down his timeline. And that I think that's a big difference. Another one is that the market is far more receptive about big bets in AI now. During when Masayoshi Son was pushing forward in the Vision Fund, there was a lot of pushback, even within SoftBank. But now we don't hear a pushback on the scale of his vision per se. It's mostly the technological reasoning that we hear, and so a lot of the SoftBank group is behind Masayoshi Son here this time.
Is it surprising that NVIDIA isn't threatened by this? I mean, is there still a lot of skepticism that this will not work?
Oh, there's absolutely a lot of skepticism. Most old hands in the chip industry kind of look at SoftBank bid with kind of bemusement even. This is something that is very difficult. NVIDIA itself almost went under multiple times in this path. It's extremely challenging, and to start from the SoftBank from scratch, in SoftBank's case, even with the support of ARM's architecture is just mind-boggling. AMD has been trying in this field, and they've made many breakthroughs, but still they haven't made a dent in NVIDIA's market share or revenue share in this market. And there are a lot of other challengers here coming into the space, including Amazon and a lot of startups. And SoftBank will be one of them competing for NVIDIA's crown.
Mayumi, thank you so much for that. Technology editor Mayumi Negishi. And of course, you can read the full story on today's Big Take on the terminal or by heading over to Bloomberg.com. Now, here are some more top corporate stories we're following. OpenAI has unveiled a new AI model that can perform more advanced human-like reasoning and solve complex problems. The O3 model will be released early next year, along with a smaller version called the O3 Mini. The release ratchets up the competition with its rivals as other AI developers push ahead with increasingly advanced technology. Chinese EV maker NIO has launched its most expensive car as it looks to double deliveries in 2025 and become profitable. The ET9 battery electric four-seater sedan is priced from $108,000 and can travel 650 kilometers on one charge. The car is set to take on Porsche AG's Panamera series and Mercedes-Benz Group AG's luxury S-range. And closer to home, Singapore Post slumping after firing its CEO and several other senior leaders following a whistleblowing report over its international e-commerce logistics parcels business. For more, let's bring in Asia Stocks reporter John Cheng. John, what do we know?
So we're looking at a rather rare episode in Singapore's corporate history. Essentially, the whistleblower report is saying several employees in the international e-commerce logistics business, they manually submitted information with the intent to, avoid contracted penalties with one of Singapore's largest customers. Well, to be honest, we don't know a great lot of details of this incident yet, but what we know for now is the company seems to have made a settlement with the customer and is not expecting any major earnings impact going forward. And of course, the fired CEO and CFO, they came out with a statement as well saying, the dismissal is unfair and, they didn't have any wrongdoings and they're going to contest to the unfair termination. So, a lot of details still waiting to be unfold. But according to the analysts we spoke to, and of course, we saw a sort of a negative knee knee-jerk reaction in the shares today, but analysts are pretty much still quite upbeat on the stock because the company has been trying to divest its non-core asset, and there might be a special dividend upcoming on that. So today's dip might be a good buying opportunity for investors.
Buying opportunity. And when you take a look at Singapore stocks, they've done pretty well. In fact, it's having its best year since 2017. Ain't too shabby for Singapore.
It's all right. It's done not bad for the market, which is very heavily skewed towards banks and utilities, as we all know. But if we take a deeper look into the STI's year-to-date performance, as I mentioned, is mainly driven by the three big banks in Singapore, your DBS, UOB, and OCBC. And the banking sector's outlook next year is rather mixed because we're entering an easing cycle, and therefore, we are probably looking at a narrower net interest margin for that sector going forward. And if we look at the IPO side of things, the Singapore Exchange this year has only had 4 IPO, which is the lowest amount in a decade. And as you all know, over the past few years, a lot of tech unicorns headquartered in Singapore, like Grab, like Sea, they have opted to go listing overseas. And there's the liquidity has really been thinning a lot for the local stock exchange. So there seems to be an urgent need to, change things around this time.
And of course, we know that a committee has been formed to see how things can be changed around. Do we know some of the ideas that they've come up with, or when do we expect to hear from that committee?
So there's been a lot of hopes and optimism around the committee, and they have set a deadline for to come up with an action plan by next summer. And before that, there might be interim updates as on some of the potential measures they might be doing. So far, as we have heard from sources, there might be a state-controlled fund. One potential model would be Thailand's value pack fund to have your state guys like GIC, Temasek to, play a role in that and have an external manager to manage it. And some other potential measures might be to get family offices to invest more in local equities, because Singapore has, over the years, introduced a lot of family offices into the country, but a lot of them aren't mandated to invest specifically in local stocks. So having those big guys to come in to play a bigger role in the local equities market would certainly help to boost trading liquidity.
Hopefully it becomes a bit more dynamic. John, thank you so much for that. Asia Stocks reporter John Cheng there. Well, here's a look at Indian markets just ahead of the open. India opens in about 3 minutes or so. We have, of course, Asia trading in positive territory on the back of those PCE data out of the U.S. The Sensex index pointing to a higher open, up 0.6% gains too for the other benchmarks. Coming up, we'll have more on Indian markets as they come online with Deepika Mundra of M&G Investments. Keep it here with us. This is Bloomberg. And we're counting down to the India Open. It's looking to snap 5 days of losses. Of course, we've seen an exit of foreign funds in particular. In fact, last week we saw a slide of 4.6%. That is the worst week in more than 2 years. Take a look where we are in terms of the Indian benchmarks today in positive territory. Pretty much in line with the rest of the region. Sensex up 0.7% gains too for the other benchmarks. In terms of the rupee, 85.04 versus the USD, which is pretty flat at this point in time. Now, India's equity culture is growing, with retail ownership in local stocks growing over the past decade. And the shift towards equity investments is expected to continue, with analysts drawing parallels with the US stock market boom of the 1990s. Let's discuss this and more with Deepika Mundra, Director of Equity Research India at M&G Investments. She's positive on India for the long term. Deepika, good to have you with us. So it does seem like a negative day is a buying opportunity.
In India, yeah, most of the time. So we're positive on India from the medium to long term. It's one of the very few markets that can give you consistent double-digit nominal GDP growth. We remain fully deployed in our portfolios in Indian stocks. We've had a bit of a misstep in the last couple of months with some earnings misses, heightened global policy uncertainty, and like you pointed out earlier, FII outflows from India, which have caused some volatility. But we would remain constructive from a medium to long-term perspective here and would use the opportunity actually to have a relook at some of the structural positive names, particularly those linked to the domestic economy.
But Indian stocks are still not looking cheap right now. Should you be buying?
So this is the constant debate that we have with investors. Valuations in India hardly ever look cheap in a global context. At this point of time, MSCI India is about 20 times headline PE, so it doesn't look particularly attractive when you look at 16 to 70 times long-term average. But if you consider the changes that have taken place in the Indian market, the size of the market itself, 5 trillion plus in terms of market cap, the number of companies that are listed, and the wide variety of sectors that you have exposure to today, as compared to more traditional sectors that you had about a decade ago, to add to that, you have much better corporate governance, much better engagement with minority shareholders, and fairly consistent mid-teen earnings growth. We don't find the valuations extremely expensive, but what we see is that the valuation disparity in certain stocks helps the case for active managers. So while we're broadly constructive on the market, we focus on active management and we take our bets accordingly.
Are you concerned that the economy is slowing significantly? We're talking about 6% as opposed to 7 or 8% previously. Should that be a concern for investors?
So we've had a slip up, like I mentioned earlier in the last quarter. I think it was expected to some extent with an election year. We've seen this in the past as well. Government spending tends to slow down around the elections. We've had a bit of a change in weather patterns, which has resulted in change in consumption patterns as well. So I think 2Q was definitely a miss for earnings, particularly in some of the consumer staple stocks. But just in terms of a broader slowdown, I don't think so. We think that the Indian government remains fairly disciplined on the fiscal deficit. Investment cycle continues, and we are consistently seeing an upgrade in income levels. Even in the financial sector, we see risks of credit costs increasing fairly contained to certain pockets only. So broadly speaking, I would say that we're not too concerned about a significant slowdown in India, and about a 6% plus GDP growth is very much plausible, and 10% plus or nominal GDP growth, which is still better than many other Asian markets would offer you.
And for you, there are themes that investors can play on, and that includes Make in India. When you talk about Make in India, are we talking about infrastructure, pharmaceuticals? What exactly are we talking about?
Yeah, so we are big believers in the Make in India theme. And from our conversations with companies over this past year, we find the opportunities creeping up in multiple sectors. So we're looking beyond just consumer electronics, which has made several headlines in terms of China Plus One and supply chains shifting over here. We see opportunities in the India's defense sector with increased indigenization, also some export opportunities there in engineering, aerospace, contract pharma manufacturing, which you also highlighted, and even the auto ancillary space, which has some troubles from a global slowdown, but we're seeing increasing shift in supply chains towards India. So big believers in the theme here, and see multiple pockets of opportunities, and not just one, which is, consumer electronics.
We know we often talk about the wealth effect in India, about a growing middle class. How do you play that?
Yeah, I think this is something which has taken a lot of people by surprise in the last couple of years. And the poster child for that has been the real estate space. We've seen several luxury apartment buildings being launched and taken up in terms of sales within a matter of days. So clearly you're seeing the wealth effect being apparent in the country as we've crossed the 2,000 per capita GDP number. So real estate is one of the ways that we can play this. And we particularly like companies which are landowners and do luxury real estate. Other than that, we see capital marketplace with the flows that we've seen in mutual funds come in. as being beneficiaries of the wealth effect, travel, which includes both hotels as well as airlines. And lastly, I would say even healthcare spending has seen a significant upgrade in the last 4 to 5 years.
Deepika, throughout the show, we've been talking about the uncertainty caused by Trump 2.0. We heard earlier about how Trump wants to take back the Panama Canal. I mean, how are you assessing the potential risk from a Trump administration and its potential impact on the Indian market?
That's a great question, because I think that's going to be one of the dominant news flow next year. And India currently has a trade surplus with the US. It's small, but it's a surplus. And we've seen the president-elect already bring up India in some of the tariff discussions in his public statements. So there is a risk of higher tariffs. I think on balance, India is at lower risk than other parts of Asia. Also, I think we need to consider at this point of time, is Trump 2.0 potentially different from the first time, given that the US itself has a higher fiscal deficit, higher inflation to solve for, and tariffs across Asia are likely to be inflationary. India remains largely a domestic economy, exposure in terms of exports to the US as well as to China in case of a slowdown in China due to any tariff concerns. Both are relatively low in terms of risk, but definitely there are going to be heightened noise levels in 2025 around the tariff news flow. I think sectors to watch here would be export-oriented, like auto ancillaries to some extent, IT sector to some extent when it comes to immigration-related news. But if we see a shift in supply chains overall, particularly from China or elsewhere, to India is definitely a candidate which is right up front. In terms of investments that we've seen from multinationals here, it's already there in consumer electronics, solar modules, the cables and wire space, as well as pharma contract manufacturing. There is a lot of evidence of investment already up and running here.
Deepika, some also say that, Modi's populist policies is a risk for the market. What do you say?
Yeah, so definitely. This is because the last 2 terms of the government have been focused on reform and infrastructure spending, which is about 3.5% of GDP now, at almost a peak from what we were seen in the past. So in terms of any populist-driven measures from the government are seen as potential risks over here. So far, we've not seen significant incremental subsidies going up in the budget, even this year itself. So we remain broadly optimistic on what the government has been trying to do, and we've not seen any missteps so far.
Deepika, thank you so much for joining us. Deepika Mundra of M&G Investments with her take on the Indian market. Let's take a look at how Taiwan stocks are doing right now. We're seeing a jump in Taiwan. The benchmark there is up by almost 2.7%. That's, of course, on the back of some reports suggesting that NVIDIA may be planning a Taiwan headquarters in Taipei. TSMC currently jumping more than 4% gains for Hon Hai, currently up by 2.8%. Well, that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.